Today, we're taking a close look at Goshen High-Tech. This is a company at a critical juncture, and we're here to analyze the high-stakes gamble it's making with its aggressive global expansion. So let's get right to the core thesis of our analysis. What we're seeing with Goshen is this fundamental tension. The company is achieving really rapid revenue growth through a massive global push. But, and this is the crucial part, that expansion is built on a foundation of persistently weak core profits. It's a high-stakes bet, and that's what we're going to break down. Okay, to really understand this dynamic, you have to look at the numbers. They tell a very clear story about the core challenge Goshen is facing. Now, take a look at this data. What you see right away is this huge gap between the top line and the bottom line. Revenue, as you can see, is climbing steadily. But look down at the non-recurring net profit. That's really our best measure of core operational earnings. It's incredibly low. In fact, it was actually negative back in 2022. And this number really drives the point home. In the first half of 2025, a full 80% of the company's net profit didn't come from its core business at all. It came from things like government subsidies. That signals a really heavy dependence on external support just to keep the bottom line in the black. Okay, so if we dig a little deeper with the DuPont analysis, the picture becomes even clearer. You see that the return on equity, the ROE, is ticking up slightly. Now you might think that's a good sign of efficiency, but it's not. Look at the asset turnover, it's actually going down. That means they're getting less and less revenue from their assets. So where is the ROE growth coming from? It's coming from one place, the equity multiplier. In simple terms, they're taking on more debt. They're using more leverage. And that brings us to a critical conclusion for this part of the analysis. The engine driving this expansion isn't operational efficiency. It's financial leverage. They're growing by borrowing to build, not by making their existing operations more profitable. So, with that kind of profitability pressure back home, what's the strategic answer? Well, for Goshen, it's been a very clear and aggressive push to go global. And you can see just how fast that's happening right here. The share of revenue coming from overseas markets has more than doubled in under 2 years. It's quickly becoming the main story for the company's growth. So why the big global push? This table tells you everything you need to know. The gross margins Goshen gets in overseas markets are significantly higher than what they're getting domestically. This means going global isn't just about finding new customers, it's a fundamental part of their strategy to fix that core profitability problem we talked about. And this isn't just a plan on paper. They are actively building out this global footprint. We're seeing major new factories scheduled to come online in the US, Morocco, and Slovakia. The strategy is clear. Build local to serve local in these key international markets. Of course, Goshen isn't doing this in a vacuum. They're entering an incredibly crowded and competitive field, one that's dominated by some real giants. To understand Goshen's place, you have to understand their tech. Their specialty is LFP, or lithium iron phosphate batteries. You can think of LFP as the workhorse. It's the safer, more cost-effective option, kind of like a reliable family car. This is in contrast to NCM, or ternary batteries, which are more like a high-performance sports car. They offer more range and power, but they come with a higher price tag. This chart really puts things in perspective. Goshen is absolutely a major global player, no question. But look at the difference in scale. Their output is just a fraction of the industry's two titans, CATL and BYD. This positions them as a leader, but very much in that second tier of global producers. So let's just recap their strategic position. On the plus side, they've got deep technical know-how in LFP, a really crucial partnership with Volkswagen, who is also their largest shareholder, and they've been very proactive in building out their global footprint. But on the other side of the ledger, they're dealing with a major lack of scale compared to the leaders, which gives them weaker pricing power, and of course that persistent issue of thin core profitability. Okay, so what does the road ahead look like? Well, Goshen's future is really going to be shaped by a balancing act between some powerful growth drivers and some very significant risks. Let's start with the potential upsides, the catalysts. First, getting those new factories in the US, Morocco, and Slovakia up and running successfully. Second, a huge one, is when the mass production orders for Volkswagen are set to kick in starting in 2026. And third, a longer-term catalyst would be any real breakthrough in their work on next-generation solid-state batteries. But the headwinds are just as significant. We're talking about incredibly intense price wars in the market. The sheer operational challenge of managing all these huge global projects at once, plus the constant risks from volatile raw material prices and new export controls. And among all those risks, one stands out:
Geopolitics. This isn't theoretical. As this quote from U.S. lawmakers makes clear, Goshen's American operations are already under a formal review by CFIUS, that's the Committee on Foreign Investment in the United States. This represents a very direct and very real threat to the absolute cornerstone of their entire global strategy.
And so this all brings us back to the one central question that will really define Goshen's future. They have successfully built a massive global asset base. They have secured the right partners. The question now is, can this enormous global gambit finally be the thing that turns all those assets into sustainable long-term profit? That is the critical uncertainty, and that's what the market will be watching.